Learning Objective 3 addresses how we calculate an overhead allocation rate and then actually allocate that overhead to work in process or finished goods. So pay close attention to this topic as we move through. It's a little more complex than direct material and direct labor. Remember what overhead includes. Any of those indirect materials, remember that we talked about in prior chapters, and indirect labor, material and labor that we may not have been able to trace directly to job 27, 28, or 29. And so as we moved that material or we incurred that labor by the supervisor, we simply put it into a manufacturing overhead account because we didn't know exactly whether it was related to job 27, 28, or 29. There are other things that go into manufacturing overhead other than material and labor. And your book gives you some examples of a couple of those different types. So, for example, depreciation. Okay, so the manufacturing plant and equipment that is used in our facility to generate products is depreciated. You talked about that in the first section of principles. We need to allocate the cost of that equipment as it is being used in production to the products that are being produced or services being provided. We may have plant utilities that are related to the manufacturing process, but we don't know how much of those utilities go to which particular job, so we put it in overhead. Insurance for the warehouse or the manufacturing facility, should I say. How much of that insurance gets applied to each job? Property taxes for the manufacturing plant. So you can see that these are all costs that are part of manufacturing our product, but it's hard to know specifically which product these costs are tied to. So we put them into manufacturing overhead. Once we have them into manufacturing overhead, we will allocate them using some type of predetermined rate, which is where we're headed. Okay, but initially when I'm recording that depreciation journal entry, I am debiting overhead for that depreciation. I am debiting overhead for the insurance or the taxes or the utilities that I'm paying for. So we see that in each case. We don't know what job the depreciation or the utilities or the insurance is going to, so we simply debit manufacturing overhead. But manufacturing overhead on its own and by itself doesn't get moved into work in process or finished goods easily. So we have to come up with what your book calls as predetermined overhead allocation rate. Okay, what are we talking about? So these costs may not occur until the end of the period, the end of the quarter, the end of the month, the end of the year, but I obviously can't wait until December the 31st when my property taxes are paid to go back and allocate cost to job 27, which was finished and sold in February. So we come up with this predetermined overhead allocation rate to decide how this overhead can get moved out of the manufacturing overhead account and into the cost for job number 27, 28, and 29. So we're going to estimate the total amount of overhead that we're going to incur during the year, and then we're going to estimate what is driving those overhead costs. So there are a couple of things that we can use as drivers. So what are we talking about? What causes me to use a machine? What causes me to use utilities? What causes me to incur insurance? And so a couple of the most common cost drivers that we will find are direct labor hours. It could be direct labor cost, or it could be machine hours. So for example, if we're a very labor intensive organization, then I could simply say on my Smart Touch tablets, for every hour that someone is working, they're causing a machine to run, they're causing me to use utilities. Or I could say not just their hours, maybe the cost, the direct labor cost is more important. Maybe I have a product that requires some very skilled technicians on those tablets, or some very highly skilled craftsmen to do a particular work. And so the cost of those hours is really more of what's driving production instead of just the direct labor hours themselves. Or if everything in our organization is automated, we can simply say that the number of hours our machines run, then I have more depreciation, I have more utilities, I have more insurance, okay, I have more cleanup from the janitorial services. And so we simply have to decide which one of these cost drivers fits our organization the best. We'll just leave it to these three for the time being, but there are multiple types of cost drivers that we can use in an organization. But what we're trying to figure out is, okay, using the illustration in your book, if we can estimate what our total overhead costs are going to be, and the illustration in your book uses total overhead. Now, we're not talking about labor here. We're back at what is our total overhead cost. So if I look at last year and I can determine the depreciation, the taxes, the utilities, the insurance, janitorial for the manufacturing facility, security, if I can look back at the prior year and see these were my actual overhead costs from the prior year, this is how much they should increase or decrease this year based on our amount of production, then I'm estimating what my total manufacturing overhead for this current year should be. So your book has estimated $68,000. So if our total overhead costs are $68,000, what is driving those costs? What is causing me to use the machines or to have the utilities? And so in this particular case, we're coming up let me say key here in what we're looking at is the word estimated. I am estimating my overhead cost, and I am estimating what is driving those overhead costs. And so in this particular case, your text said, well, our direct labor cost, not direct labor hours, but our direct labor cost. The more we spend on direct labor, the more we spend on running machines, running utilities, paying supervisors. Okay, so once again, the key is that we are estimating what our overhead is going to be, and we are estimating what the driver is going to be that is pushing those overhead costs. So with our estimates of $68,000 for overhead and $170,000 for labor cost, what we have actually come up with in this particular scenario is that 40% of our direct labor cost, if you were to take all of your direct labor costs for this particular organization, we are spending 40% of our direct labor in overhead. Okay, so direct labor is still there. It is what it is, but we're saying for every dollar that I spend on direct labor, I'm spending 40 cents in manufacturing overhead. Stop at this point, rewind, re-listen if you need to. This is critical. Once again, if I am spending, for every dollar that I am spending in direct labor cost, I am spending 40 cents in manufacturing overhead. So every dollar of labor costs me 40 cents in depreciation, in utilities, and plant supervisors. Okay, so this is my estimated allocation rate that I am going to use to apply overhead as we move through the year. Okay, so if we bring it back down just a little, once again, we're looking particularly at job number 27. And if we use this same 40% of direct labor cost that we saw in the prior illustration, if you'll look at our direct labor, it shows us that our job cost sheet tells us that we spent $1,250 on labor. If our allocation rate is 40% of labor cost, then let me go back and see if I can write for you here. Simply what we've done is said 1,250 times our allocation rate of 40% equals $500. Okay? As sloppy as that is, hopefully it helps. I have manufacturing. I am going to allocate manufacturing overhead to job number 27 in the amount of $500. How did I do that? I've assumed that for every dollar I spent in labor, I spent 40 cents in overhead. So $1,250 in labor. Your labor doesn't change. It is what it is. But as a result of the $1,250 in labor, it is causing me to spend $500 in running my machines, depreciation, utilities, taxes, insurance, supervisor salaries. Okay, but can you see why it is important that we know that there is actually $500 worth of overhead in this job? Because I need to know the completed cost of this job of $4,500 so that I know that the unit cost is $300, and I know how much I can move to finished goods inventory when this job is complete. I don't want to wait until the end of the year. I can't wait until the end of the year. This job is ready to move. So I'm using my predetermined overhead rate to calculate manufacturing overhead. So your slides move back out to a year-wide picture here, assuming that your direct labor, once again, we're talking about our direct labor cost for 2018 were $169,000. Okay, once again, if our overhead allocation rate is 40%, for every dollar I spend in labor, 40 cents of that is going to be applied to overhead. So once again, as we saw on our job cost sheet, here's what happens in our T account. We move $67,600 worth of manufacturing overhead out of manufacturing overhead. So if you remember, when we paid for the utilities and the taxes and the insurance, or we made the entry for depreciation, we put those costs into manufacturing overhead. Now we are moving them out of manufacturing overhead using our predetermined overhead rate, and we're allocating $67,600 worth of overhead to work in process inventory. Okay, it's not as simple as moving material or labor over. It's a little more complicated. And once again, remember that it is an estimate. Okay, since it is an estimate, okay, at the end of the period, this manufacturing overhead account needs to have a zero balance. Okay, it's not something that we have left sitting around. We need to use up all of our manufacturing overhead by the end of the period, which means we need to get it allocated to the correct jobs. Since it's an estimate, our account's probably not going to be zero. And if we have a debit balance left in our manufacturing overhead account at the end of the period, remember we debited it for everything that we spent. And if we still have some debits in manufacturing overhead, then we didn't allocate enough to our jobs. If we have a credit balance sitting out in manufacturing overhead, that means we've moved too much overhead into our jobs. We've overallocated and moved more in there than we should have. And an adjustment will have to take place. Okay, we'll take a look at that in a later objective. And know, once again, this is a complicated topic, so take some time to make some notes, to review your overhead calculations, and then we will move forward into completing and selling the goods and moving the cost from finished goods on the balance sheet into cost of goods sold on the income statement.